Do you know the best way to check any of the mutual funds performance? Most people just look at the CAGR, but there is a much more accurate way to measure how good a fund actually performed through rolling returns. Let me explain why. So CAGR only looks at the two specific dates. It takes the NAV on the exact day that you have invested and compares it to the NAV on the day you are checking it. The return you see is calculated only on the difference between these two random dates. Because of this, it becomes very personalized. It is only accurate for that one exact time frame. If your friend invested in the exact same fund just a few days after you did, their profits could be completely different because of sudden volatility in the market. So whenever you measure growth between these two dates, you are heavily relying on the luck of your timing. To get a real and an accurate picture of how a fund actually performed over a 2-year period without any bias, you need to look at the rolling returns. Instead of taking just one snapshot, rolling returns look at a multiple overlapping time frames. For example, instead of calculating solely 2-year returns, it calculates a 2-year return starting on the 1st of January, then it calculates another 2-year return starting on the 2nd of January, and then 3rd of January, and so on and so forth. And it keeps on doing this day by day over several years. Then it gives average of all the returns calculated over multiple time frames. So this becomes a game changer because it completely removes time bias or the luck factor of a good entry or exit date. By looking at an average of hundreds of overlapping periods, you finally get to see how consistent the fund actually is, irrespective of sudden volatility in the market. You can easily check the rolling return in the fact sheet of a mutual fund. So next time, when you analyze any of the mutual funds, do check the rolling returns over CAGR to get the most transparent picture for any of your investment decisions.